Welcome everyone this morning to our webinar on the topic of financial planning for business owners. So just I suppose a note to start, the webinar is being recorded and we will send out any slides along with a recording to everyone who's registered. My name is Orla Walker and I will be moderating today's session. And to say this is an interactive webinar, and I suppose the benefit of being live is that you get to ask your own personal questions as they relate to you and your business. So please do make use of the Q&A and the chat to send through any questions that you have, and also to send through a little bit of information on you and your business. So you can let us know if you're a sole trader, a limited company, if you're just getting started and kind of making that decision as well, because it'll all help us to guide our conversation today. So with me this morning is Anya Cullen, who is a senior financial planner at Ask Paul, and Larissa Feeney, who is the CEO of Accountant Online and also a chartered accountant. So Larissa, I'll hand it over to you to introduce yourself.
Thank you, Orla. Good morning, everybody, and welcome, Anya. So my name is Larissa Feeney. As Orla has said, I'm CEO and founder at Accountant Online. And Accountant Online is an online chartered accounting firm. We work predominantly with small business and we have currently about 2,500 clients and they're served by a remote team of 70. So you're very welcome here this morning. This webinar is business financial planning, or financial planning, I should say, for business owners. And the reason why this webinar is so popular, and we do this webinar very often, the reason why it's so popular is because what we find is that business owners take care of their business and the business's finances before they take care of their own. So this is a little bit of a discussion around what you should be doing as a business owner to safeguard your own finances and to grow your own wealth as your business hopefully grows as well. So once again, you're very welcome. And Anya, I'll pass it over to you to introduce yourself and to start your presentation.
Thank you so much. And I have to say the partnership between ourselves, Ask Paul, and Accounting Online, we, as Larissa said, have done this a couple of times and had a really good response. So please, if there are any questions, feel free to pop them in. And as we're going through the presentation, we'll be able to do this. I'm just going to, can I... 1 second, share my screen.
Yeah, no problem. You work away, and you work away. So once again, if you can, please just add into the Q&A or into the chat. If you are a sole trader or a limited company in particular, that would really help guide our discussion. If you have any questions over the next hour, please just pop them in again, the Q&A or the chat. We'll come to them and we'll answer as many as we can today. And those that we can't answer or those that need further research, either myself or Anya will come back to you after the webinar.
Perfect. So can everybody, has my screen updated now to
the
first of the slides? Fantastic. So in terms of myself, my name is Anya Cullen. I'm one of the senior financial planners here with Ask Paul, and I'm doing financial planning since 2008. So kind of a tough year, I suppose, to get into financial planning in terms of the global financial crash and everything that followed afterwards in terms of the IMF being in Ireland. I've worked in brokerages, I've done the main pillar banks and looked after high net worth individuals in there. And then I moved across to Ask Paul and Fairstone in 2020. And today is really about, when we call it a money masterclass, looking at the relationship between most of you being self-employed, limited companies, and how do we balance that, your business finances with your personal finances. So what I want to do is just give you a little bit of a background on who Ask Paul are, what we do, and the benefit that we can bring in terms of financial planning to you and your business. So both from a personal and family perspective, but also from a business planning point of view. So we currently have approximately just under 294 million in assets under management, and we would be looking after on a day-to-day basis over 10,000 clients. We communicate with those clients and our key goal is to bring jargon-free financial planning to our audience. We have over 106,000 followers on Instagram and we regularly would do questions and answers. You can find us at Ask Paul now. And also for anyone who is on TikTok, that's really growing at the moment, almost up to 80,000 followers. Also over 1 million hours watched on YouTube. So there's a huge amount of financial information available now, but it's just to be mindful and to be very careful where you get your financial information from. There are an awful lot of US or non-Irish based financial advisors out there. So we're giving you specific advice based on Irish rules, Irish tax. We've over 220 visitors, 1,000 visitors to our website. And the big thing is we engage with over 32,000 clients on a weekly basis. So very much pro-education, holding your hand and developing a financial plan with you. So with that in mind and where we are, what I want to kind of bring to you today is what is financial well-being, because there's a lot about well-being out there. A lot of the kind of the pillar banks have jumped on this. And what we want to do is look at where are you today, because right now, in terms of financial independence, it's actually rated as the biggest contributor to overall well-being, suggesting that financial wellness should be receiving the same, if not more attention than your physical and mental health. So there's lots about what do you eat? Are you sleeping properly? Are you exercising? Cold water swims, all of that. But what we here at Ask Paul are looking at from a financial well-being point of view is a definition that we have come across from the Consumer Financial Protection Bureau in the USA. And this definition, we feel that they've nailed it. So what I want to do is I want to bring you through what we define financial well-being as, and this is both from your business perspective and your personal. So it's a state of well-being where you have control over your day-to-day and month-to-month finances. It's you have the capacity to absorb a financial shock and you are on track to meet the goals, your financial goals, and have the financial freedom to make choices that allow you enjoy your life. Okay, so we think that's really encapsulating everything that a financial plan is. There's nothing scary in that statement in terms of doesn't mention tax, doesn't mention investments, doesn't mention pensions. So let's break it down and actually have a look and see, well, what does it mean at its base level? Because at the base level, financial planning should be easy, okay? So what this is having control over your day-to-day and month-to-month expenses. That means that you can get to payday without needing to go into credit, without reaching for a credit card, without checking your bank account to make sure that there's enough money in your bank account to cover your direct debits, or going into short-term debt to cover your finances, okay? So that means that we have a budget. And again, it's really important to have a budget to know what we have coming in every month, but equally as important, where is that money going? So what are your specific outgoings? What is compulsory? What is discretionary? Okay. And then having the capacity to absorb a financial shock. So this could mean that something breaks, something needs to be replaced unexpectedly, or something bigger, maybe an illness, an accident, an injury prevents you or one of your staff from working. They provide a key role. So we would always start with an emergency fund. So at home, in personal finances, we would say the absolute minimum you should have in an emergency fund is €1,000, somewhere that it's not very easy to access, that you can't just transfer it into your account. We tend to recommend the credit union. It's a really good home for that. But most of you today are self-employed. €1,000 in your business account is not going to cut it. And particularly if it's mainly you providing the services, because if you're going out, you're giving up your time, you're earning your income every week or every month. Say you're earning €3,000-4,000 a month. Well, then what happens if you're unable to work? This is case by case, but essentially your emergency fund should be at least probably 3 to 6 months net pay. That could be between 12 and 20,000 in your business current account, that if you're unable to work for a period of time, you have the capacity to absorb that financial shock, get yourself well, get whatever it is that's broken fixed or replaced, and move back on with your business, okay? on track to meet your financial goals. So what I'm going to ask you, if some of you have pen and paper in front of you, if you're sitting at the office, maybe some of you are actually out working, you could be in your cars, phone or pen or paper. What I want you to do is on track to meet your financial goals. So what are financial goals? So every week I hear different financial goals. I want to retire early. I want to clear my mortgage. I want to put my children through the third level education. I want an education savings plan. I'm a first time buyer. I want to save a deposit for my property. Whatever your goals are, they're specific to you. So if we just stop for a minute, I want you to write down 3 financial goals that you have. And I want you over the next kind of present throughout my presentation, but over the next day or two, to really think about those financial goals and what kind of a plan do you need to have to achieve those. Some you'll be able to achieve quite soon. It might be clear your debt. You might have some short-term debt. Others, it'll take longer. I want to retire early. What do we need to do? So I'm just going to stay silent for a minute and you guys just write down 3 financial goals.
And this,
Sonia,
Anya, should...
Sorry.
Oh, sorry, Orla. I was just going to say,
Sorry.
this should be related to your personal goals as opposed to your business goals.
Correct.
Sorry, I was just going to say there's a couple of people that joined there just after we got started. So thank you to everyone that's already sent in, whether they're a sole trader or a limited company. But for anyone that's just joined, if you want to give us a little insight into your business, and also if you have any questions, just to send them through to us as well, and we'll be fielding them to Anya and Larissa a little bit later on.
Yeah, perfect. And then in terms of then the goals, okay, this is really what those goals are to try and do. It's have the financial freedom to make the choices that allow you enjoy your life. So today is very much about you work hard, you leave your family, you go to work every day to earn the money. It's that money should be there to enjoy life. It's not all about the what ifs and the if, ands and buts. It's about how do we work to bring in an income to actually enjoy what we can do with it, okay? And that's really where this presentation is going to go. So if we look at that statement and financial well-being about managing our day-to-day expenses, being able to absorb a risk or a shock and really enjoying life. Here's a lovely kitchen. And this is the next little kind of action I want you to do. So we have our 3 financial goals. But in this kitchen over here beside the oven is an ATM, okay? And what I want you to do is, I have a calculator here. I want you to take out a calculator or open up your phone and open up your calculator. Because as we've mentioned, you go to work every day, okay? You give up your time to earn an income. If I say the average income in Ireland net take-home pay, I'm going to work with about €3,000 per month. Net, okay? What I want you to do is I want you to multiply that by 12, okay? That's your net income per year, and work it out for whatever you earn, whether that's weekly, you pay yourself, fortnightly or monthly, okay? I'm 35, I'd like to retire at 65. I don't want to wait until the state pension, which is more than likely going to be at least 68, if not older by the time we get there, right? So if I multiply that by 30 years, my potential earnings, my value to myself and my family is over €1 million if I never get a pay rise and I never build my business up, okay? And what I want you to think about is, if I called out to your house this afternoon and I put an ATM in your kitchen and I loaded that with whatever figure is on your calculator, be that on your phone or an actual calculator. If I put €1 million in that ATM and I said that ATM is going to spit out €3,000 in €50 bills every single month. But there is a risk over the next 30 years that that ATM may break down and stop spitting out money, okay? Would you insure that ATM with €1 million in it? And that essentially is the value that you add to yourself, to your business, to your family, every day of working. So when we look at financial planning and all the money that you earn, where does it go? So we've mentioned a budget. So up here, there's a scale of 0 to 10, okay? If you have your financial emergency fund and a budget in place, you're at 10. If you've never done a budget and you've no emergency fund, you're down here at 0, and we need to build this up, okay? So it's really important, both personally and business related, that we know what our money coming in every month is and what we have going out. We also have an emergency fund that if something costs more, we have a buffer that's there to look after us, okay? The next part of our financial wheel of debt is if you have no debt, you're down here at 0. Some of you might have a mortgage. That would be seen as good debt. It is your home, or it might be the commercial premises that you're in. But credit cards are one of the worst and highest interest debts that you can have. And it's about understanding how to use a credit card in the most efficient manner, that if you are paying the highest interest rate on the credit card, it could be between 18 and 24%. We want to get you out of debt, okay? And what we want is an emergency fund. We want to reduce any debt that you have, and then any long-term debt. The bank will always make sure that they are protected in terms of mortgage protection, life cover, big commercial loan, they'll make you take out life cover on that. But who's looking after you, your business, maybe your business partner? Again, there's lots of different avenues we can go down from a business owners and business planning perspective, as well as looking at maybe protecting your income. So if we go back and I say, what is your biggest asset? Is it your house? For most people, no, it's not. It's the income that you guys earn that pays the mortgage, that puts food on the table, that pays the utility bills, and that generates money coming into your business. And once we've got a surplus here, savings on deposit have been historically low for the last number of years. They're starting to get better in the last month, but inflation is really, really high. So again, we have a very different inflationary period to where we were 3 years ago. And it's looking at how do we keep on maintain the value of our money over the medium to long term. Mortgages, I'm happy to answer questions on, very topical. The European central rate has gone up 10 times since last July. So again, we get a lot of questions on tracker mortgages. Should I fix or should we buy at the moment? If you're a first-time buyer, again, we can look at that. It's one of the biggest financial commitments you will make. And don't forget, you buy a mortgage. So you are paying the bank interest over the term. It's a really important decision. Even if you're in a home, you're looking to trade up, you're looking to switch your mortgage to get a better rate. So all of this, again, from 0 to 10, rate yourself out. And then we have pensions. So this and tax are one of the, or two of the most efficient ways of building wealth over the long term. So pensions are a way for you as a company owner or a sole trader to actually extract wealth from your company in an efficient manner, and over the medium to long term, actually build a pot that is going to be your replacement income in retirement. Obviously, it's tax deadline for the 31st of October for anyone who is looking for pensions. And in 2022, anyone looking to fund a pension for 2023, we do have up until the middle of November. But it's being aware of your tax. So again, are you a lower rate taxpayer? Are you a higher rate taxpayer? And what we come across is a lot of business owners are actually paying themselves a very low rate because they don't want to pay tax. But is this always in their best interest? I'd argue not always. So again, any questions kind of between tax or pensions, myself and Larissa, I'm more than happy to answer those as we're going through. And your financial wheel of life is going to be very, very different depending on what age you are. So this again is case by case. It is not the same for everyone. So if we take your early years when you're kind of 18 going into your 20s, you're probably paying a lot of tax. You could be on emergency tax, tend to have car loans, maybe you've taken a loan for a holiday. But as you get older, you get more into maybe relationships, saving for your first deposit, securing your mortgage. People are getting older now, securing mortgages into their 30s and 40s before they're getting onto the property ladder. Mortgages are out to age 70. So again, if we're living longer, which we are, the average life expectancy in Ireland right now is high 80s. It's making sure throughout different stages of our life that we are achieving a 10 on most of these. And by the time we are in retirement, we don't have any debt, our mortgage is paid off, and that we are aware, where is our income going to come from? So is it going to come from assets like properties we had a mortgage on, now we have a rental income on? For some people, maybe ill health is going to visit their doorstep. We need to look at long-term care. We need to look at the Fair Deal scheme. Potentially parents sometimes look at downsizing to release equity from their home. So myriad of different things going on, and it is very much case by case here in terms of the financial wheel of life. And then if we can get this to actually move on to my next slide, hold on one second. Let's bring this to the end. There we go. Back to planning. So we've kind of discussed the personal financial budget. We have one online. I will send it on to Orla and Kelly, and they'll send it on afterwards. But it's also about, once you do your budget, how often are you checking in? We'd recommend you need to check in on your budget at least twice a year. So every 6 months, possibly more, depending on if you're expanding, if life changes are happening, you're getting married, you're getting a mortgage. It's really important to review your budget and update it regularly. Same goes with your emergency fund. If you're single, if you're married, if you've got children, it's going to differ depending on your own circumstance. Same goes if you are what I would consider like, I'd have a lot of people like plumbers who are one man in a van. If that's just you and you're responsible for bringing in all of the income, your emergency fund needs to be much bigger than maybe a PAYE worker who's in a company who maybe has income protection, has death in service as part of their employee benefits. They're not as at risk potentially and may need a smaller emergency fund than the self-employed individual who's completely reliant on themselves for bringing in their income. So again, we've looked at what are your financial goals, and I want you to bring this back to what you have written down personally. Again, some of these home improvements, actually I didn't mention, that's a big one at the moment with the cost of properties. People are actually staying in their own homes, attic conversions, extensions, renovations, retrofit is something that's really important as well. So what are your financial goals? And make sure you do have your short-term goals. That could be, I want a holiday, family holiday abroad next year. Long-term goals, I want to clear my mortgage by 55. I want to retire at 60. So again, really important to have a goal and work towards it. And with pensions in mind, people get confused as to what a pension is and how technical it is. All it is a long-term savings account that you put money in and it is invested over the medium to long term. And what I want to do is show you the compound interest. So again, bringing you back to school, we're looking at €250 a month here on the blue line, growing at 3% per annum. So relatively low risk, okay, and low return. €250 a month coming in at 6% per annum, and €250 a month coming in at 9% per annum. Go back to 1990, okay? So over a 40-year period, and that's the kind of time frame many people will be employed by. If you consistently invested €250 a month and you only got 3% return, you'd be up on about €185,000. If it was 6% return, it's just under 300,000. But the beauty of compound interest, it's not trying to time a market. It is time in the market. that the earlier you can start investing, whether that's in a regular savings plan, an investment plan, or your pension being one of the most efficient ways to generate wealth, you could be up over 540,000 euros for just regularly putting 250 euros away. But there is a caveat in here, because things don't stay the same price over a 40-year time period. Inflation, which we are all very aware of at the moment, kicks in. Goldilocks figure, where the European central banks, all the big financial institutions are trying to get inflation back to, is a 2% inflation rate. So that is the cost of goods and services consistently over that time period growing by 2%. So the real buying power of your money here is actually dropping. That's gone from nearly 550 to 350,000 euros. That's multiple compounding in terms of if it was sitting in a bank account, and inflation at the moment is about 5.5%. Your money is devaluing. The inflation is eroding the real buying power of your money. So when I'm looking at how do I replace your income, how do we retire early, how do we make sure we've enough money for our kids, third level education in 18 years, we need to look at compounding. And this is a nice representation in terms of what is the S&P 500. So these are the top 500 companies on the US stock market over the last 5 years, so since 2019. And what we can see is there was a big drop, and this was actually a big drop in 2019, but time makes that look pretty small because we had a really strong following 2019, okay? But here's COVID and markets dropped. But what happens after that? Markets recovered, and they actually recovered very, very quickly, went on all-time highs up until Russia invaded Ukraine. We had an energy crisis, we had rising inflation, we had supply and demand issues, but the markets have still ploughed on. So what we are looking at is over the medium to long term, when we try and build wealth, it's making sure we're building wealth in the right way. And one of the key ways, and some of you will have only started up, you're not thinking about pensions yet, but the way pensions work is they use the tax relief available. So I mentioned earlier that a lot of people self-employed I meet want to pay themselves the minimum so that they don't fall into this 40% tax bracket. So right now you can earn up to 40,000 euros and you pay 20% tax. Everything over 40,000 euros is at 40%, okay? That's going to change next year. We're getting an extra 2,000 before you're going to jump up into the higher rate of tax. But what that means is for every 100 euro, whether that's a week or a month going into your pension, if you're on the lower rate of tax, you're only putting in 80 euro. The government is putting in 20 euro, right? If you're on the higher rate of tax, you only have to put in 60. The government will put in 40. So this is tax that you should have paid the government, but you didn't. So let's bring it back to the ATM in your kitchen, right? You go and you put 60 euros into that ATM. You press check balance on the ATM, but it says you have 100 euros in your account right now. That is the tax relief. And you have two ways of doing it. Your company can put it in directly as an employer contribution, or you can be putting it in as an employee contribution. Depending on what age you are, the government gives very generous tax relief. It is never too late to start a pension. I have people up here between 55 and 65 that cleared the mortgage, they've got their children through their third level education, and all of a sudden what they were paying into their mortgage, they're now putting into a pension. They're getting 35 to 40% tax relief on it. It is on a max earnings of 115,000, but as business owners, you also have the beauty of putting in employer contributions. So I want to thank you for your time this morning. More than happy to answer questions. And for anybody who would like to look at either a business owner's review or a personal financial consultation, you can book in and we'll give you a 25% discount code. Orla will kindly pass this around afterwards with the slides. And then just in terms of obviously a mortgage, pensions and investments, there are some standard warnings there. I'll just leave this up for you to read it, but more than happy now to take some questions and come back in, myself and Larissa, for you all.
Thank you, Anya. Fantastic presentation. Really great information there for business owners. Thank you. We appreciate you coming on today. I just have a couple of general questions before we go to the specific questions from that have been sent in, if that's okay. Now, you have mentioned about, you've spoken about pensions. I'm wondering, do you see, sometimes we have about 2,500 clients and most of them are small business owners. And generally, not always, but sometimes I see business owners sacrificing their own personal wealth for the good of the business. And they do that for various reasons. They might want to build cash in the business, or sometimes you've mentioned it, there's a little bit of a fear of perhaps paying tax. So going into the higher rate, for example, or sometimes even going into the lower rate. It just depends on the individual and their earnings. I'm just wondering if that's a mindset that we have to be careful of as business owners.
Very definitely. And what I would commonly see is all your energy goes into how can I grow the business? How can I get more in? What more can I do? And it could go 5 years. And you all know you kind of need to look at your own kind of house, your own personal house. But you're just so busy with the day-to-day runnings. I think this is where it's invaluable if you have a financial planner and you just check in with them once a year. It's what's changed. Did you have a good year? Was it a not so good year? Are you growing? Did you need to expand your business? It's about consistency. It's not about big lump sums or big kind of commitments. It's small, regular, over the medium to long term, and time is your biggest asset. If you're only in your 20s or 30s, I have 30 years to go. As I just mentioned there, even if you're 55, lifestyle is a little bit different in terms of our parents probably were getting married, getting mortgages in their 20s. Most people today are getting married in their 30s, having children maybe mid to late 30s, mortgages are the same. So everything's that little bit pushed on in life, that if we leave everything till when we think we're going to have money, we're always chasing that elusive goal and nothing gets done. You're much better off saying, okay, this is where I am. I can only afford to do the minimum, but it's getting started and having the correct advice to help you, educate you. And as more money comes in, we can grow it over time.
Fantastic. Thank you, Anya. And you're absolutely right. You know, it is time is our biggest asset. And that get into the habit, I think, of investing personally is a fantastic idea from an early stage in your business, and also paying yourself adequately for the work that you do as a business owner in your business. If it's at all possible to do that, and if it's not possible right now, that you do that as soon as it is possible. It really helps you understand how sustainable your business actually is over the longer term. I just want to ask you one last question, and that is that you mentioned interest rates, the current interest rate hikes that we've seen over the past 12 months or so. Hopefully we're at the top of the cycle, or certainly approaching the top of the cycle now, and hopefully we'll start to see it coming down over the next couple of years. What's the impact, though, from both the personal and business perspective? You mentioned tracker mortgages, so maybe you could touch on that for anybody on the call who may still have a tracker. And also, if there is anybody in the call that is in the lucky position of having excess cash in the business that they have decided they don't want to put into a personal pension for whatever reason, and that may be growth or whatever coming down the line, what's the best advice for them with the current interest rates?
We are a full brokerage, so we do the financial planning, but we also have our mortgage arm. It's knowing what's out there, right? So again, if I suppose bring this back, we have been in an extremely low interest rate period since 2013. At one stage, we were in negative interest rates. The banks in Ireland, the lowest interest rate you could get with the pillar banks was about 2.3%. So if you're on a tracker rate and you're on a 1%, 0.75, that would still be considered a good tracker rate, okay? But there, again, depending on the term that's left, if you only have 5 or 7 years left, there are some really good, attractive fixed rates still available. But how long are those fixed rates going to be around? Because the banks haven't passed all of those ECB rates on. And if we're at a 4.5% base rate now, and previously Irish banks took a margin of more than 2%, it's really important that you start looking at, if you're on a variable rate, should you consider fixing it, giving yourself the peace of mind that you know exactly what your mortgage is going to be for the next 5, 7, 10 years. We also, for the first time in this country, have lifetime mortgages where you can actually take out a mortgage for 15, 20, up to 30 years. And again, is that something that you should consider? But it's not a one size fits all. It's not if you have a mortgage or if you have a tracker, you should be giving it up. Some trackers are still going to be phenomenal value. But if you've moved house and you brought your tracker with you, all the banks added 1% to that tracker. That's not a good value tracker anymore. You could be 2.5%, 2.75% above the ECB. You're over 5.5%, 6% right now, when there's still fixed rates just over the 4% available. If you've done some work in your home and you have a B or energy rating of a B3 or higher, there's really attractive green mortgage rates. So what you need to do, you need 3 things on your mortgage. You need to know how much you owe your bank, what your rate is, and what your term is. And then after that, we can help guide you. Are you on a good rate? Should you consider moving and switching? Lots of banks are offering cash back, so it's not actually going to physically cost you any money, but it's going to save you a huge amount of money in the long term in terms of, I mentioned it, you buy a mortgage, you pay interest on that mortgage to the bank. It's making sure you can get the best deal for yourself, because it is going to be your biggest financial commitment.
Great, thank you, Anya. Great information. Orla, I'll pass it over to you if there's any questions from anybody on the webinar.
Great, thanks so much, and thanks again, Anya, for that. It was a fantastic presentation, and I'm sure everyone got a lot out of it. And we do have some questions coming in here, so I think some probably for you, Larissa, and some for Anya as well.
Yeah, perfect.
So just, I suppose, a bit in relation to the pensions there, Anya. So I was considering a private PRSA and having my company pay directly into this. Is this a good approach? I'm coming up to retirement, but I just want to save spare cash from the company into a pension for the next few years.
Yeah, really, really good approach. They changed the rules last year under Finance Act 2022. So the funding limits have been taken away from PRSAs. So essentially, if you have money sitting in your business, you currently have an opportunity to transfer, if you've never done a pension before, up to the threshold, which is €2 million from your business into a personal asset. The way pensions work is once you retire, you will take a quarter of that fund completely tax-free, and then the balance you are going to use to replace your income over time. So again, with good financial advice, you'll pay minimal tax in terms of going forward, but a private PRSA with an employer contribution is a really smart idea, particularly if you're approaching your retirement age.
Great, thanks, Anya. And I suppose to touch on the compound interest there that you talked about, and the inflation as well. Why collect money like 20,000 if the net buying is 2% inflation loss and the 10% buying power of hard assets and stock market?
Good question. It is because and again, it brings it back to time. Okay, no one has a crystal ball. We don't know exactly where inflation is going to be in 5 years, but I can tell you the cost of goods and services is always going to go up. If you leave your money sitting in a bank on deposit, you are guaranteed it is not going to keep up with inflation. And you can go back to kind of the turn of the century in terms of every 10 years, we can look at cash versus bonds, and these are bonds like you buy in a post office where you will get a return. They can be corporate or they can be government. And then you look at equities, and there's a risk and reward payoff that, yes, equities can go up and down. We've seen that right now in terms of volatility within the market. But if you hold them long term, okay, so 5, 7, 10 years plus, you have a much better potential return than had you done nothing and just left your money sitting on deposit.
Great. Thanks for that, Anya. And I suppose, Larissa, there's a couple of questions here from David. He's given us a bit of an overview of his business, and I suppose they'd be more tailored to the accountancy side of things. He is starting to work as a fractional PO/PM advisor. He provides the services to clients inside and outside of the Republic of Ireland. Are there any differences between working for Republic of Ireland clients and non-Republic of Ireland clients, or any tax implications?
There may be, depending on where you perform that work and who you're working for and where they are. So I assume from what you've said, it's a business that you're working for. So it's a B2B service. So you need to get advice around VAT and also around income tax or corporation tax, depending on how you're structured. It can make a difference where you perform that work. So say, for example, if you're spending a lot of time with clients in the UK, it may be necessary to set up what's called a permanent establishment in the UK, or to report some income there. So I would advise you to maybe get in touch with us, and we can give you some tailored advice to your specific circumstances.
Perfect. Thanks for that, Larissa. He was also asking, if I register as a sole trader on the 1st of November, when do I have to pay taxes for the first time? So I suppose that would be a common question we get on our team, Larissa, about when they start paying taxes.
Yeah, absolutely. It's a question we get asked all the time, and it's a great question. If you register for income tax on the 1st of November 2023, then the tax year for sole traders in Ireland goes from January to December, usually, although you can change it if you wish, but the tax year goes from January to December. So your first accounts will be for November and December 2023, and your tax is due the middle of November next year. So the date is always slightly different every year, but the middle of November 2024 for online filing and paying. Now, sometimes you can get an extension to the following year, but I always tell clients not to avail of that extension, because the sooner you get into the habit of preparing for a tax bill as a business owner, the better. It's already difficult to wait 12 months, I always feel, in terms of preparing yourself and preparing your cash flow for making that payment.
Great, thank you. And then I suppose another part of David's question there is, I'm considering joining my business with 2 friends into a limited company in 1 or 2 years' time. Does it make sense to start as a sole trader and then switch to a limited company in 2025?
Yes, absolutely. A lot of businesses start off as a sole trader. It's a much more simplified structure. It's easy to register, it's easy to deregister, and it's also, for the main part, cheaper to run from a professional fees perspective. So a lot of businesses start off as a sole trader and then only incorporate into a limited company when it's appropriate to do so. So you've given a great example there, Orla. Perhaps if you're going into business with others, a limited company can provide better structure. Make sure you get a shareholders agreement. It's always important to have that going into a limited company structure. And others may incorporate if, for example, tax, it becomes a problem. So if your tax bill gets too high, you can pay less tax through a limited company. So some incorporate for that reason, and then others incorporate for reasons such as insurance, or perhaps because they're working in a specific sector that requires incorporation. So there's various different reasons, but it's absolutely fine to start as a sole trader, yes.
Great, thanks, Larissa. And then I suppose back to you, Anya. What are your thoughts on options trading?
It depends on where you go and where you get your advice. And I mentioned this earlier, that there is an awful lot of online financial advisors promising you stuff. I would just caveat, if it sounds too good to be true, it probably is too good to be true. In terms of myself and Ask Paul, we only give advice on regulated and authorised investments, so we wouldn't be advising on that. There's absolutely no problem if you have time to research and do that, but for the most part we'd be saying you're self-employed, you're spending, we've already discussed the energy, the time, people forget about their personal finances. So do you have time to properly research investments? Or if there is a fund manager who's looking after potentially 10 billion in assets under management, are they going to be able to do a better job, have better resources in terms of actuaries, economists, accountants, giving them advice that sometimes the fee, and you all hopefully charge professional fees and services for your services, you pay for what you get. If something is free, it's not always best.
Thanks, Anya. And as you say, I know you touched on TikTok there earlier on, and I know myself, my feed is full of financial advisors, and they may not always be given the best advice. So definitely worth reaching out to someone like Ask Paul for kind of a more structured guidance, tailored to your needs as well.
And there was something else I saw somebody, sorry, put in it was further up, just about pensions and allocation rates. It's really important to understand what an allocation rate is on a pension. So PRSAs are currently in favour because there is no funding limits in terms of the change in the Finance Act. But PRSAs come with different charging structures depending on who you go and the advice that you get. An allocation rate means how much of your money is actually being invested in your pension every month. If you are only getting a 95% allocation rate, which would be quite common, you are losing 5% of every single pension contribution. Doesn't sound much if you're only putting in €100, you're only losing €5. But if you're putting in €1,000 a month, that 5% has a massive impact over time. Ideally, you want to try and get 100% allocation. This is where the full amount that you're putting into a pension every single month is actually being invested on your behalf.
Great, thanks for that, Anya. So again, if anyone has any other questions there, please do keep sending them in. I know someone was asking, there is a webinar recorded, so it is being recorded and it will be sent out afterwards, along with some good resources from Anya there as well. You see there. So I suppose another question, maybe for you both, for say if you are a sole trader, if you're just starting out, you're kind of a sole director limited company, when is the best time to decide, when to outsource some of the responsibilities versus, trying to manage everything yourself?
Great question. It is something that we get asked all the time, is when does a business owner, when is it appropriate for them to take care of those tasks that possibly could be outsourced, and when is the best time to outsource? The tasks that are usually outsourced first are those tasks that maybe a business owner is not strong in. So for example, payroll or bookkeeping, it could be marketing, things like that, that maybe, like I know for me, it was marketing I outsourced very early on because that's an area I wouldn't be strong in. And the answer is, it depends on the individual business. It depends when it's appropriate for you. It depends on when you can afford to do it. I always advise that a business owner should weigh up, if they're saying yes to doing bookkeeping, for example, what are they saying no to? So, is there a possibility for you to generate more sales for your business in that time, in those 2 or 3 hours you spend doing your bookkeeping? So will you make more money for your business doing that? And then it's a very easy decision to make, because if you're saying no to generating more income for your business, then it makes sense to outsource bookkeeping or payroll or whatever, because it will cost you less. So it is an individual one that you have to weigh up for your individual circumstances. Anya, would you add anything else to that?
I'd 100% agree. And I would also say, if you want to scale up, you can't be everything to everyone. You can't be the accountant, the salesperson, the director, the kind of compliance. It's very difficult. And even, I suppose, the journey we've had here in Ask Paul, we're now Ask Paul powered by Fairstone, had kind of our CEO, Paul Merriman, not outsourced exactly what Larissa said, things like compliance, like our marketing. The company was just growing, and you're going to get to a point where you're going to limit yourself if you don't consider taking on that kind of expertise and freeing yourself up to do what you do and what you're best at.
Great, thank you both for your input there on that.
And Orla, I just see a question there from Alan's around personal capital gains tax and losses, and why is the rate 33% and not 20%? Such a great question, isn't it? Like, why isn't the rate 20%? It just, like, it isn't. There's no appetite in government. We've seen the budget there, 2 weeks ago now, and there was no movement on capital gains tax rates. There has been no movement on capital gains tax rates for a long time, from a personal perspective, and there doesn't appear to be any appetite in government to make any changes to the capital gains tax rates or to the bans. So, I mean, we would all think, of course, that it should be lower. It's not, and I don't think it will be in the foreseeable future. They don't seem to be moving on that at all. In terms of the loss rules, the loss rules, again, without knowing individual circumstances, it's very hard to advise. But essentially, in most cases, if you suffer a capital gain, a capital loss on a transaction, you can offset that against a capital gain. There is, I suppose, rules around that, and there is criteria, and you have to be careful. So if you are in the position where you have had capital gain and you think you have a loss to offset against it, then do get advice before you submit anything to revenue.
Great. Thanks for that, Larissa. And another great question coming in here as well. So how long should you give a business until it reaches feasibility level typically? I suppose it'll vary from business to business,
Yeah,
but
that's a great question though, because and it is related to what we spoke about earlier in the webinar, where I do see business owners, and Anya, I'm sure you do too, that maybe are long past that point and are still in business. And I often do wonder, why. And sometimes it's a passion or it's what they love to do. But I think it's accepting that in that case, it's not a viable business. It's just something that we love to do, and we're happy to sacrifice income or profitability to do whatever it is. But if it's a business, and let's assume that you're not in development, so you're not developing a product, you already have a product out to market, or you actually have a service that you're selling. And if you're trying to figure out when it is that the business is profitable or feasible or viable over the long term, then first of all, you have to answer how much it is that if you were to work full time, how much would you earn? And that's the first level you need to get to. If you can get to that and you're making profit after you're paying yourself, then that's a viable business. So the business, in order to be viable, you have to make profit. No, like a business that makes losses over the long term is not a business. That's a hobby. And that's something that we like to do. And that's grand. It has its place. But I would say give it 2 or 3 years at the most. And if you're past that stage and you're not making a decent salary that you would command on the marketplace yourself, plus profit, and that profit that's very individual. But if you're not making a decent salary plus profit in the business, then I would definitely reconsider if the business is viable over the long term.
Great, thanks, Larissa. And another question there. So do you recommend for the company to have an emergency fund where it would be subject to corporate tax, or to only have a fund privately to cover emergencies?
For me, it is absolutely vital for the company to have an emergency fund, even more so if you have employees. Even more so if you get credit from suppliers, and especially if you give credit to your customers. So all of those reasons. Anya mentioned earlier on about having potentially 3 or 6 months cushion there as a business, I think is what you said, Anya, and I would agree with that. Especially, as I said, if you have an employees to pay for, and you've got salaries to make on a monthly basis, that's one obligation that you can't not meet. So 3 to 6 months minimum as a business cushion. And equally, as in the personal side of things, I think Anya mentioned minimum 1,000. As business owners, you probably need to up that, because if there is a problem with cash flow in the business and you do have employees, your employees will always get paid first and you'll always get paid last. So you need to have a financial cushion there personally to be prepared for that.
And I would just add, depending on how big your company grows or scales, this also comes into how do we protect you as a conversation. There are multiple different ways in terms of there are corporate income protection plans that you can take out for yourself, first and foremost, but then as the company grows, it's a brilliant retention tool in terms of keeping your best talent on, that maybe you do offer them, well, if there is an issue and somebody is unable to work for a period of time, there's actually an insurance policy that's going to feed your business account, and therefore you will still be able to meet your monthly obligations.
Thank you both for your insights there. And I suppose one other thing that kind of feeds into kind of that financial planning, as well as kind of grants and supports that might be available to businesses. So Larissa, I suppose you would recommend for reaching out to the local enterprise office?
Yes, if you are a small business, then please do make sure you have reached out to the local enterprise office. They are there to help and they are there to mentor, and they do provide mentoring, they provide training programs and basic information about how to start and signpost you to any further help that may be available to your business. There's also grants, feasibility grants, priming grants that may help you in the early months and years of the business. If you don't fall into the category for local enterprise office, you may fall into Enterprise Ireland. And again, they're there to help you and help you access funds that may help grow your business. Always bear in mind that the local enterprise office and Enterprise Ireland, they do require a certain amount of commitment in terms of the forms that you have to fill out, and they usually require you to attend a Start Your Own Business course in order to access grants. And I would say it's completely well worth it to do that. Apart from the fact that you're accessing the grant funding, you're gaining really valuable knowledge about the right way to start a business.
Great. Thanks for that, Larissa. There's a lot of thank yous coming in there in the chat there for both you, Larissa, and Anya. So thank you so much for your presentations today. For anyone in the webinar that wants to reach out for kind of further information or guidance or support from either Accountant Online or Ask Paul, Anya, if you want to remind us on the contact details for Ask Paul there.
Yeah, you can go, there's a couple of different ways you can log into our website. It's just askpaul.ie. You can go on to Instagram, we're askpaul_now. We are the blue verified tick, or you can contact me directly. I'm anya.cullen@fairstone.ie.
Perfect. And a reminder that Anya has that discount code there as
I
well.
haven't moved in enough time. Sorry.
No problem at all. And for ourselves at Accountant Online, so if you are kind of still at that point of deciding whether to set up as a sole trader or limited company, or you're set up and you're kind of looking for some further guidance or for services for your business, you can reach out to us on hello@accountantonline.ie. And I suppose both websites as well have a lot of resources there as well that kind of answer a lot of questions that you might have. So feel free to look at both of those websites as well for kind of additional guidance. So thank you again for everyone for joining us. As I said, the webinar is recorded, so you'll be sent out afterwards along with the slides and those extra resources as well. But yeah, so have a good afternoon, everybody, and a good rest of the week. Thanks you again, Anya and Larissa.
Thank you very much. Thank you. And thank you, Anya. Great to see you again. Okay, take care, guys. Bye-bye.
Bye-bye.
Thanks. Bye-bye.